Tonight we'll continue our discussion of borrowing to invest with pension plans. We'll do a quick discussion, real short discussion of life insurance, interest rate risk management, and then endowments. Endowments really doesn't fit in this part. I would consider them more in price risk, but I just want to point out the interaction between stocks and bonds and interest rate risk, where you'd actually want to maybe use interest rate risk as an offset to stock risk. So that's where we talk about there. And we'll probably get into liquidity risk tonight. Our second risk, interest rate risk was the first, and then liquidity risk. So we've covered borrowing to invest. It was a fairly complex discussion. It can get a little bit confusing because there's so many moving parts. But what does this all mean? So we know pension liabilities are extremely sensitive to interest rates. They have inflation risk. When a firm has a pension plan, it's a very high beta liability because it's so sensitive to interest rates and inflation, which are systematic risk. So when a firm has a pension plan, it will increase its beta and greatly increase its cost of capital. And then if the firm then turns around and puts that money that they didn't pay their employees, that they instead keep, and they put that in the stock market, that's something else that's a very systematic risk, a very high, beta type of event, very unlike a firm borrowing money, investing in the firm itself. And because of that, borrowing through a pension plan and putting it in the stock market should reduce the value of a firm. And even more so, and really key to this, is buying stocks. The present value or net present value of buying stocks should be zero, and actually slightly even slightly negative because of all the fees firms pay on their pension plans and trying to beat the market when they usually don't most of the time. So you put all together, and you're probably better off for the value of the firm of actually immunizing this risk, just like we're going to talk about life insurance companies do. Life insurance companies don't buy stocks. They don't try to beat the market, even though they may strongly believe the stock market will outperform bonds in the long run. But because of the valuation of the firm, that all that extra return you get from stocks is completely offset by the higher expected risk and the higher required return. So, I try to make a strong argument. You might not buy it. I'd be curious to see your opinion, but that's the theory. I'm not giving you my out and left field theory. This is financial theory. It's textbook theory that says that firms should invest their pension plans in a very immunized way to eliminate the risk, these systematic risk. But why don't pension plans do that? And it gets back to that career risk. Everybody's doing, and we'll talk about that more when we talk about endowments. Everybody's doing what everybody else is doing because that's the safe from a career risk standpoint. That's the safest thing to do. I believe because of that, instead of us having pension plans, which I think would be really valuable to a lot of employees who are not prepared for retirement, because they've rated their 401k plans, they don't have this pension plan that they can rely on. Because of that, and because of the very bad investment strategies of pension plans, we've seen pension plans being shut down in the United States, and we're seeing retirees really not prepared for retirement. Now, it's interesting to me, Social Security, I remember several years ago, there was a guy at UTSA who was going around pushing that UTSA should become a lobbyist to put Social Security into the stock market. And I use these arguments with him and his argument was, well, the stock market makes money. The Social Security is just investing in treasuries that only make, back then 4 or 5%. His argument was happening right before the financial crisis of 2008. So I think the 2008 stock market drop completely killed his argument. But just because something has a higher expected return doesn't mean that's what you should do, because higher expected return usually has higher risk. And so because of that, if pension plans have been managed like life insurance companies, I think we'd have plenty of pension plans today. We'd have a whole lot more Americans who are prepared for retirement. So taking all of that, we're looking at this from a company standpoint of offering a pension plan. But what about you as an individual? How should you view this? Because there's a lot. Remember those pension liability risk, longevity risk, interest rate risk, inflation risk. The fourth one was adverse selection, so that one doesn't apply to you, but the other three do. You do have interest rate risk, you do have inflation risk, you do have longevity risk. So you have three of those four risks. Should you be investing radically different? Am I recommending that you put 100% of your money in bonds? And no, I am not. There's something else here. So corporations should hedge out the interest rate risk of the retirement plans by allocating to bonds. Am I recommending that that applies to individuals? It applies, but there's one big missing component corporations do not have that individuals have, and that are really just two: human capital and human capital optionality. Corporations do not have human capital as an asset. They can hire humans and they pay humans, but human capital is an expense for corporations. But for you as an individual, human capital is probably your most valuable asset, and it's an enormous asset on your balance sheet, much larger than at your age. For college students, it's much larger than any other asset you have, unless you have a really wealthy family that you've got millions of dollars sitting in a trust for your name. If you're a typical college student that has more debt than assets, human capital is your most valuable asset. So what is human capital? Human capital is the present value of your net future earnings. It's the largest asset you have. For most people, human capital is extremely bond-like. It looks more like a bond than a stock. Most of us, it's true in a recession, we're maybe a little more worried about losing our job, but most people don't lose their jobs in a recession. Our unemployment rates go from like 5% to 8% or 9%. So yeah, there's a group that lose their job, and they don't, but most of them don't lose it for years. So the impact on your human capital of recessions is not nearly as large as it is on the stock. So our human capital, the present value of our future earnings, is very bond-like. And when interest rates fall, that actually increases human capital. So human capital looks a lot like a bond. Now, there are some people whose jobs look more stock-like. If you're a commissioned sales person, maybe for Men's Warehouse, your income will look more, your human capital will look more like a stock. But for most of us, our income, our salary looks more like a bond. So if it's bond-like, we don't need to allocate our investments to bonds because we already had this humongous bond-like asset called our human capital. And we can hedge human capital very easily by buying life insurance. So we have this huge asset. It's very bond-like. It could go to zero if we were to die, but if we have people dependent on us, we can buy life insurance and hedge that risk out. So as we think about retirement, for you as an individual, you don't need a large allocation to bonds early in your career because you have this massive asset called human capital. As you age, human capital shrinks, and so you're losing that bond-like human capital. So as we age, we should be moving more and more from stocks into bonds. We look more like what I'm said the corporations should be like. We have interest rate risk and we have inflation risk, and we need to manage more toward that. Human capital optionality is another component, and what that means is you can adjust your career as the economy changes. You can get new skills. You can get a graduate degree. If coding, coding's a huge thing, it may be absolutely critical, so maybe you take some classes on Python or R or Java or whatever. So as you age, though, that human capital optionality, that declines. So as we age, we need more optionality in our portfolio. And we're going to talk about that. Stock options are a great hedge against major bear markets as we age. When we're young, it's not a big deal because the stock allocation is a small part of our overall risk in the context of our human capital. If you look at your portfolio without thinking about human capital, then yeah, it looks really, really risky. But if your human capital is, say, $5 million and your stock portfolio is $5,000, you're not even going to notice that. But as you age and your human capital shrinks, your human capital optionality shrinks, you need to move more to bonds and put more optionality in your portfolio. We'll talk about optionality later when we're talking about price risk, how I like to use options. Be real careful on the exam when I talk about my approach to pension plan asset liability management. I'm not talking about options there. My optionality is for individuals. It has nothing to do with what I said with pensions. So some students get confused. Remember, my solution for the pension is balance sheet immunization. They should buy bonds that match the duration of their liabilities so that they eliminate the interest rate risk and also think about the inflation risk. That has nothing to do with optionality. I only talk about optionality related to individuals because of the unique nature of human capital. So here's the paper I use in my life insurance class. And they say, what are we trying to do? You as an individual, well, over your lifetime, you're trying to maximize the expected value, that's what the E means, of two states. 1 minus D, that's your alive state. D is your dead state. So you don't know how long you're going to live. You could die tomorrow, you could live another 90 years. But you want to maximize the overall nature of this. When you're young, your dead state is really unlikely, so you've got a 99.9% chance of being here, but there is some chance there. 1 minus Q is essentially, the D actually here is bequest, how much you want to leave to your heirs. So your alive state, what you leave to your heirs is actually harming your alive state. When you're dead, how much you want to leave to your heirs is the biggest part of that. QX is your probability of dying, so 1 minus QX is going to be really low when you're young, and it's going to increase as you live. U, remember U from economics, is your utility, or your happiness, or your contentment. So we're trying to maximize the utility of your alive state and utility of your dead state. Your alive state is going to be influenced by your wealth and your human capital. Your dead state is going to be influenced by your wealth and the O, which is your life insurance. I don't know why life insurance is O. So essentially what you're saying is you need to set up a model so that you maximize this entire equation. This equation shifts from the alive state to the dead state as you age because the QX goes up. And you have to decide how to put all this together. But the wealth is where your asset allocation is, how much you should have in stocks and bonds. When you're young, your stock allocation will be very high because your human capital is very bond-like. As you age and this Q increases and the D increases because you want to leave more to your heirs, you'll have to shift your wealth more and more to the bonds. So, there's actually a formula in this article. Those that took my life insurance class probably well remembers this article. It was a pretty intense article. But we are trying to think about this in a holistic way, thinking about all of your risks, the stock risk, interest rate risk, inflation risk, risk of death, put all that together and try to come up with a model so you're maximizing that whole thing together. And so you as an individual, you have one thing, or really two things, but related to human capital and human capital optionality, something that you have that corporations offering pension plans do not have. In fact, if you die while you're working, that helps the corporation a lot because they don't have to pay anything for your pension. So they don't really care about human capital because, it's true, they're going to pay you a percentage of your salary. They're more interested in your QX, your probability to die, and they actually are happier if you die earlier than die later. So there is that huge difference between corporations and individuals, but without the human capital, what I'm saying about corporations with pension plans and individuals, I would say it's the exact same thing. So there's the argument. Now, hopefully you can go back to these videos and you can, in your own words, not using my blog, in your own words, write out what I'm talking about here, borrowing to invest. Remember the initial question, does it make sense to borrow at 3% and put all that money in the stocks that you think will make 8%? Will the value of the firm go up? And now you can apply that same concept to your own personal portfolio. So let's go back to the class notes and let's shift gears to life insurance companies. Life insurance companies have liabilities that are similar to pension plans, not nearly as long duration, but similar. They're different than banks or pension plans in the fact that they're very complex. Their balance sheet immunization is actually known as asset liability management in life insurance companies. It's usually run by actuaries, not by finance people. And the reason it's complex is they have what's called disintermediation risk, and their liabilities have embedded options. The disintermediation risk, what that means is when interest rates shoot up, their customers leave the life insurance company and they take their money and go invest in banks or bonds where they can get higher returns. Because in life insurance companies, they put all their money in bonds, and so the rate that they pay their customers doesn't move very quickly because they have all these 5 and 10-year bonds. If interest rates shoot up real quickly, they're going to keep offering about the same rate, whereas bank CDs might jump up to 8 or 9%. And that's disintermediation risk. Disintermediation risk is when you move from one intermediator like a life insurance company to another one, to a bank. And so insurance companies have that problem. The other problem they have is when interest rates fall, because they have a lot of 5 and 10-year bonds locked in, their crediting rates, what they pay their customers, doesn't drop, whereas bank CDs drop a bunch. And so when interest rates fall, insurance companies can get a lot of money from banks, which they don't really want because they're getting all these cash when interest rates are low, and that's going to kill the rate they're paying their other customers. So whether interest rates rise or fall, they're killed. At the bottom, when interest rates fall, the other risk they have is that the states require them to have a guaranteed minimum amount that they pay out. I have some annuities from insurance companies that have a minimum of 3% they have to pay out. So right now they're making barely more than 3% and they're paying me 3%. They're losing money on those products. So it's a really complicated product. We further these as embedded options. Their customers have the right to put more money into the product. They have the right to take money out of the product, and your customers will do that for life insurance companies at the worst possible time. They like to add money when interest rates are low because insurance companies have these nice portfolios that are 5 and 10 years, but they don't want all that new cash. It's going to destroy their entire portfolio and harm all their customers. When interest rates rise, people take their money out at the worst possible time. You know, that interest rates rise, all these life insurance customers want their money back so they can go invest somewhere else. And the insurance company has to sell bonds when interest rates have risen, so they're losing money on their bonds. So it's a huge risk. Life insurance companies do extremely well when interest rates stay nice and stable. They don't like when interest rates rise and small. I told my life insurance company, life insurance finance class last semester, it's like a short straddle on interest rates. You can go look up a short straddle option strategy, and it looks like an upside down V, where they make money as long as interest rates stay within a narrow range. But if interest rates move a bunch, they start losing a lot of money. So you might look that up. It's not part of this class, it's part of my previous class in life insurance finance. But it's a very, very difficult product. So the actuaries have to be more precise in how they balance sheet the immunization, and they get all the way down. Here's a term you can definitely look up on the internet and get more into. It's called key rate durations. And what that means is if their liabilities have a duration of 5 and their assets have a duration of 5, just matching that up is not good enough. You actually have to match all what we call buckets, because the duration of either one can change really dramatically. So you need to have a 1-year bucket duration that's matched up, a 2-year bucket that's matched up, 3-year, 4-year. And I was very impressed. There was an actuary at UTSA. He had this down to a science. He could tell the bond investor exactly what kind of bonds to buy, their duration, their maturities, their convexity, even key rate convexity. So what he could do, the person managing the portfolio, John, there's 2 Johns. John was the actuary and the other John was the portfolio manager. They were constantly in contact. Anytime the portfolio manager, needed to buy a bond, he would go to John, the actuary, and say, I want to buy this bond. What impact is that going to have to our key rate durations, our key rate convexity? And they had it lined up. So what they're hoping is no matter what interest rates did, they had a portfolio that was going to move in a way to protect them from what their customers did on the liability side. It is incredibly complex. And that's the reason why actuaries are involved. The math is really quite difficult here. There's a lot of unknowns. There's a lot of assumptions they have to make. For example, when interest rates rise, not 100% of the customers are going to leave. But they don't know what percentage will leave. And one of the risks I remember John, the actuary, kept talking about is, I'm working for a life insurance company that's been selling a lot of annuities during a time when interest rates did almost nothing but fall. We really don't know what our customers will do when interest rates rise. I can make assumptions, but we don't know for sure what they'll do when interest rates rise. So he had to make assumptions, run some models, and just test it. So if you're an actuary, you're thinking about the life insurance side, this to me is in a really exciting area of the work in insurance. This balance sheet immunization for life insurance companies or asset liability management. It's incredibly complex, very mathematical, involves a lot of advanced math, advanced knowledge of interest rate theory. You'd have to probably take some classes on interest rate theory, and includes a lot of modeling, a lot of programming. You have to be really strong in your program. You can't really just use a basic Excel. You have to know some Python and SAS and other things. So it's a great career. If you would be specializing, most life insurance companies have an ALM department that's just a couple of people. It's not a massive army of 50 people. But what they do is incredibly important to keeping the company solvent. All right, now let's talk about endowments. I worked a lot with an endowment during my career. Endowments are charities. I now manage a small charity. It's only a few $100,000, so it's not the hundreds of millions of dollar endowments I was managing at UTSA. But endowments, they're charities. They raise money for some particular group or cause. And a lot of times these charities are helping people who are facing financial hardship and they need financial assistance. So let's think about endowments. Now again, this applies more to price risk, but I do want to bring it up here, and we'll probably come back to it again when we talk about price risk. But think about, there's three components to an endowment. There's the donor, there's the portfolio that the donor's money is put into, and there's the clients, the recipients of the endowment's funds. The donors are usually wealthy individuals. My charity is being supported by middle class people who are sending us, $100, $200 a month. But large endowments like the one I worked with at UTSA, their donor was UTSA itself. But endowments usually have large portfolioed donors, very wealthy individuals. They have large security portfolios. They tend to invest a lot in stocks. Well, like pension plans, endowments are allocated very heavily to stocks, usually 60%. That's just the typical allocation. And remainder is in these intermediate term bonds. Durations around 5 years. So what does that mean? So here's where I want you to think in terms of scenario analysis. Another thing you might think about this is stress testing. You see that a lot in your paper 1. You're probably seeing stress testing, stress testing, stress testing. So what is stress testing? Let's run some scenarios. So what scenarios might we do? Well, let's do 3 scenarios. One is a very strong economy, one is an average economy, and one's a very weak economy. Let's throw the average economy out because that's kind of boring. Let's look at the strong economy. A strong economy, the donors are doing great. Their portfolios are doing great. Their stocks are up. They're probably making more money in their jobs. They want to donate money. They're happy. They want to donate money to get some tax shielding. They're happy. What about the clients of the endowment? Well, they don't have very many needs because the economy is strong. They're not having any financial problems. So the endowment's not really having a lot of call for cash. They don't have a lot of needs from their clients. So that's great. In a strong economy, the donors are donating a lot. The endowment puts its money in the stock market. The stock market's up a bunch. So the endowment's getting donations and making money in their portfolio. And their outflows are smaller than normal because people aren't in a bad situation. So that's great. That's wonderful. Now let's go to the weak economy. Okay, in a weak economy, the donors are doing badly. Their personal portfolios have dropped. They're losing money. They don't have a need for tax breaks, so they cut back dramatically on how much they donate to the endowment. The endowment's portfolio is losing money because stocks are falling, and they have these 5-year duration bonds, which aren't doing much. 5-year duration bonds are not going to move much in a recession. They're going to be fairly flat. They may be up 2 or 3%, but they're not going to offset a 20, 25, 30% drop in stocks. And then on the client side, the clients have much bigger demands because you have a weak economy. Their financial stress is much higher, so they're asking for much more money. So everything, it's like the perfect storm. Everything is lined up. The donors are giving less, the portfolio is losing money, and the clients are demanding or asking for more help. Is a large stock allocation really what you want this endowment to do? You want something that does well in good economies and completely blows up in a bad economy. And so what I actually started recommending, again, this has nothing to do with borrowing to invest in the pension plan. Don't get this confused. So what I'm recommending, first of all, if endowments are going to do that, putting their 40% in 5-year duration bonds is not going to help them at all. The stock market is going to fall so much that the slight increase they might get from 5-year duration bonds is just not going to be that great, especially since most of them don't buy treasuries. They actually buy corporate bonds. And corporate bonds will be a little bit under stress as well during a recession. It may actually fall. In 2008, stocks fell 35%. And corporate bonds fell 15 to 20%. Yeah, treasuries were up, but endowments don't buy treasuries. They buy corporate bonds. We'll talk about that later. You're going to see when we talk about correlation, one of the biggest lies that financial planners tell is when they talk about bonds. And we'll get into that. So endowments need to do something radical. If they're going to put that much in stocks, they need to do something radical, not just stick their money in 5-year duration bonds. So what might work? Here's a couple of approaches you might do. So these are my strategies. I call when everyone's laughing, I want to be smiling. When everyone's crying, I want to be laughing. So we want something that does okay in a strong economy, but might not be, the stock market's up 30%. You might only make 22%. But yeah, that's okay. But when the market crashes 30%, you're up 5, 10, 15%. So, and I actually have followed this strategy my own. I would not have been retired in 2009 if I wasn't following this strategy. So one approach is put all of your money in stocks. We'll definitely talk about this later. I'm going to actually show you the numbers. Put all of their money in stocks instead of 60% in stocks. Put 100% in stocks, but then hedge that with options. And I'm going to show you later that I actually think you can get a higher return doing that than you can having, well, I'm especially going to talk about it as a strategy for your parents. A strategy of if you're 40% stocks and 60% bonds, I actually think you can be better off with 100% stocks with option hedging, but we'll look at the numbers there. Again, do not put this in your answer for borrowing to invest. It's not part of that question. Are you going to have a high allocation to stocks, say 60% or higher, partially hedged, but do something radically different in the rest of the portfolio that would do really well when the economy is weak? Don't put it in the 5-year duration bonds. Maybe you have some in gold. Maybe you have some in much longer duration treasuries. So you have something that actually might not do well in a strong economy. Long treasuries don't do well in a strong economy, but it won't kill you. And that 60% allocation to stocks will do great. And then when the market crashes, that 30, 40% in long treasuries will do extremely well and come back and protect you. So think radical. Don't put 40% in 5-year duration bonds, especially corporate bonds. It's just not going to give you much of a hedge. We'll talk about that. That's a key component to this concept of correlation that we'll talk about when we get to price risk. So why doesn't the profession focus on balance immunization? Why does it instead focus on career risk? We've already talked about this. And that's because the profession's biggest risk is not their client's biggest risk. The client's biggest risk is balance sheet immunization risk. It's asset liability risk. But that's not what our profession's biggest risk is. Our biggest risk is career risk. Our biggest risk is doing something that everybody else is not doing. That's where our career risks come in. That's because of the prudent expert rule. That it requires a fiduciary portfolio to use the care, skill, prudence, and diligence, and to act in a way that someone familiar, and here not just familiar, the expert world is familiar and an expert, so really knows what they're doing, what they would do. And if most people in your career field, in your field of study, if most of them are 60% in stocks, for you to go 100% stocks, hedging it with options, you have tremendous career risk. You might think 60% in stocks and 40% in 5-year duration bonds is a really stupid strategy, but if everyone else is doing it, you better do it. That's why when I immunized USA's pension plan, there was a lot of stress there. I was doing something almost no other pension plan in the entire US was doing. And so if something had gone wrong, my own personal liability risk would have been tremendous. Even though I believe that's the place they should have been, it made the most sense. I was taking tremendous career risk because I was doing something I thought was right, but was not the normal practice out there. And it's still not the normal practice out there. So the language is important because it tends to make us all heard and do the same thing. It argues against the unconventional. Your career is safer when you follow the crowd. It's better if you're going to fail, never fail by yourself. Always fail with everyone else, and then you don't have to worry about losing your job. And so it's tough. That's, again, another reason why I recommend the family office as an investment strategy, because family offices tend not to care if you're doing what everybody else is doing. They give you a lot more freedom. So it's an interesting concept. We'll get into this again much more when we talk about price risk and we talk about correlation and hedging and that kind of thing. But here what I wanted you to think about is interest rate risk as helping you. Actually taking interest rate risk in a more aggressive way in order to offset the price risk of stocks. But again, we'll get into that later. I probably should have moved all of this endowment discussion down under price risk, but I wanted you to start thinking about it as kind of a good introduction to price risk, which we'll get to here soon. So let's get to the second risk, liquidity risk. So liquidity risk might be the most difficult one to measure, and it's getting a little bit difficult to actually define. So you'll notice some of your banks will have a whole section on liquidity risk. You might read it. There's definitely a close tie between liquidity risk and price risk, and the reason for that is the traditional view prior to the 2008 crisis, the traditional view of liquidity risk is you needed cash, and the only thing you had to sell was very illiquid, and you had to take a huge discount on the price. You had a fire sale, and because of that, you lost a lot of money. So that's why it looks a lot like price risk, because you are losing money because you have to sell the asset. So prior to 2008, liquidity risk was only a risk if you needed cash. If you didn't need to sell anything, liquidity risk wasn't an issue. So the act of selling the asset causes the price to fall. So if you have a $400,000 house and tomorrow you suddenly need $200,000 and you have to sell the house in 2 hours, you're probably not going to get a good price. That's a very illiquid asset. However, if you need $200,000 tomorrow and you have $200,000 in treasury bills, you won't have any trouble selling those and getting your cash tomorrow, and won't lose any money doing it. So some assets are very, very liquid. When you sell them, it doesn't cause the price to fall. Other assets, if you got to sell them fast, you're going to have to take a huge haircut to sell them fast. So if you're doing artwork as your asset allocation, so you're buying Rembrandts or whatever, and you need cash tomorrow, you're probably not going to get a good price for that asset. It's very illiquid. Now that's prior to 2008. So I'll talk about what does it mean since 2008 here a little bit later, but prior to 2008, an illiquid asset would be something like real estate, even corporate bonds. Corporate bonds are more liquid than real estate, but they're not as liquid as stocks and treasuries. Corporate bonds are usually sold over the counter, so there's not, you can't just call up your broker and say, I want to sell $15 million of this bond. You have to find who wants to buy it. It's sophisticated buyers and sellers, it's brokers, it's people setting up the trade. And they can be extremely difficult bonds to buy and sell during a credit crisis like we had in the fall of 2008. It become especially, we have what we call a liquidity crisis. That's what 2008, a liquidity crisis where no one wants to buy corporate bonds and no one can sell them, and you take these, I mean, it was amazing. I was on a committee that anytime a bond price fell more than X percent, we had to have a special committee meeting in order to revalue our mutual funds. What would happen is we might have $10 million in a bond and it has not traded for weeks and weeks, and then suddenly someone in Idaho sells $20,000 of that bond because they desperately need cash. And so we had this bond on our books, say at 96, but because they were desperate for cash in Idaho, they sold that small piece of bond for, say, 40. So now we have a bond we think is worth 96. We did the analysis, we think it's worth 96. We have it on our books at 96, but someone just sold it for 40. And so the rules, the accounting rules say, hey, we have to reduce the value of this bond down to 40 because we now have a more up-to-date market value. And that's what we call price discovery. And that committee, I was on that committee and did not meet for the longest time. We hardly ever met. And then suddenly in 2008, we were meeting almost every day. It was just getting ridiculous because bond markets were so volatile and these bond prices moved so much. There were bonds trading 20 cents on the dollar that we thought were worth 80, 90 cents. So we thought they were stretched, but not that stretched, especially commercial mortgage-backed securities. They were trading so cheap, and yet the underlying assets looked very, very strong. There's no reason for them to fall that much, but the market just went in free fall. And so what does that mean? Well, after 2008, the definition of liquidity has changed. Definite liquidity is you're worried about the impact of a liquidity crisis on your illiquid assets. Because even though you may not need the cash, if the bond price falls 80%, you're going to have to do something about that. You can't say, well, that's just a liquidity crisis. In previous liquidity prices, a bond you thought was worth 96 might fall to 89, which is pretty bad. But you didn't have a bond you thought was worth 96 falling to 20. And so 2008 was just an extreme liquidity crisis, and now people have to say, you know what? If I have an illiquid asset, I've got to worry about bonds that may be illiquid. Even though I have no need to sell them, I can pay all my bills without selling them. So that's why I say there's a close tie between liquidity risk and price risk. Because some assets, price risk is not that big of an issue until a liquidity crisis, and then suddenly they're in the eye of the storm. So you have to think about these assets. So the extreme lack of liquidity caused asset prices to behave very differently than what we are accustomed to. And no one knew who owned what, and it became this kind of domino effect throughout the entire financial institutional society. So the Federal Reserve has this issue where the Federal Reserve in 2008, they had to decide with AIG, with Lehman, with Washington Mutual, they had to make these decisions. Is this a liquidity issue or is this a solvency issue? If it's a liquidity issue, it's temporary. The Federal Reserve will provide cash to AIG or whoever, Freddie Mac, Fannie Mae, or Lehman. They decided not to provide anything to Lehman, but provide cash to AIG. Because it's a liquidity crisis, we're going to give you cash so you can survive. However, if it's a solvency crisis, if the Federal Reserve messes up and they think it's a liquidity crisis, but it's really a solvency crisis, then they're giving money to a truly bankrupt company, and it's just going to cost us taxpayers a lot of money. So the Fed has to figure out, is this entity under stress because of a temporary liquidity issue, or are they under stress because they're really insolvent? Their view of Lehman was really insolvent, so they had to let them go. With AIG, I think what they saw with AIG, if AIG goes under, the domino effect we see so great. So even though it might have been a solvency issue, they felt like they had no choice. And plus, they were a little shocked at how much the market reacted to Lehman going under. And they were too scared to let that happen with AIG. You think about this same thing with the Japanese banks. There were some Japanese banks that everyone believed they were truly insolvent, but the Japanese government kept providing liquidity to keep them in business, and so you just had this kind of walking dead institutions. They probably should have just let them go insolvent, go under, because by funding them, they were just making the ultimate blow up that much worse. How do you measure liquidity? And this is so difficult. It's an extremely, there's no obvious ways. And let me tell you, what you might think is, well, let's look at history. Let's see what illiquid assets had done in prior liquidity crises. But the problem is every crisis is very different. You do a similar analysis that you do with credit analysis. You're trying to understand the underlying investment, the underlying companies, the exposure, their industries. You want to understand that. You want to see what would happen if they went insolvent, what assets could you get. So a lot of the protection for liquidity risk is the same protection you have for credit risk. Remember, when you're doing paper one on credit risk, you're seeing collateral. You're seeing some backup that makes sure that if they go under, they have good collateral. So if you're doing an airlines and they go under, maybe because of COVID-19, at least you can get some planes as collateral that will, at least back up, and those planes will be worth something, hopefully. But it's an extremely hard thing to measure. Stress test is, and you'll see this on the liquidity a lot, stress test is probably the #1 way firms assess liquidity. That's what we did at UTSA with our Calm committee. We would meet quarterly and we would run through liquidity scenarios. What would we do if this happened? What would we do if this happened? We had close to $30 billion in liquidity resources that could, and we think through each scenario. What if our bank has problems where we could invest in our bank CDs? What if the life insurance company has problems? We could fund them more, give them more capital, or there's just different things that we could do. We went through all those scenarios, but liquidity is a really tough one. The problem with stress testing is that what's a liquidity issue today will not be a liquidity issue in the future. So how do you look for the next liquidity crisis? And this is something I hope you'll remember after this class, because if you do, it might save you a lot of money. The next liquidity crisis, I forget where I heard this. It might have been, oh, boy, I can't even think. Maybe Oak Tree Capital, I forget. I was listening to a podcast, and they said the next liquidity crisis is likely to be today's most crowded trade. Where are people just desperate to buy something? Maybe that's Bitcoin. Maybe Bitcoin will have a liquidity crisis. Maybe it's real estate today, you know, especially residential real estate is having a boom time right now because interest rates are so low. You know, I'm starting to see more and more people buying properties to flip them again. A liquidity crisis would shut that down pretty fast. Some people talk about sovereign debt. There's so much government debt out there. Could we have a liquidity crisis there? It's hard to imagine that since governments can actually print money. But we get to the point, there's so much government debt out there, and then suddenly people start worrying about governments, and people start trying to sell their government bonds real quickly. Could that be a stress test? We usually don't think of governments as being illiquid, but we've never seen that much government debt out there. So that's why it's so hard to predict, because the next crisis is going to be probably what people are doing today in the herd mentality of everybody buying. Buy, I want to buy it, I want to buy it, I'll borrow money to buy it. Something you could certainly go and look up is Minsky moment, and I don't know how to spell it, but Minsky moment, try your best to spell it. You'll find it in Wikipedia. Maybe it's M-I-N-S-K-I, Minsky moment, and that's his theory is an asset price gets beaten down, institutional investors start coming in, the price starts recovering, and then more investors start getting in, the price starts recovering. Then the price starts momentum and going fast, and then retail investors and other investors, they actually start getting in and they actually start borrowing money to get in, and then the price really shoots up, and then it hits its peak and it starts to decline a little bit, and a slight decline because you have all these people who borrowed money to buy this asset. They're now panicking. It was like, wow, if this asset price falls, I'm in trouble because I have to repay all this debt. And that causes this domino effect on the way back down, and the market just crashes. So on the way up, it was very, very liquid. All these people are desperately plowing money into it, even borrowing money to plow into it. And then suddenly it unwinds and it's extremely illiquid. So yeah, it's a tough thing to manage. How do you mitigate it? Well, you have concentration limits. That's something the word limits, whenever you see that, that is usually a mitigation strategy, not a measurement. So your limits, how much you're allowed to have in any one company, how much you're allowed to have in any one industry. And industries has become important here. Some consumer staples, energy companies, obviously travel companies. There are certain industries that have really, really struggled the last few years. And so I know at USA in 2008, there was a high allocation to financial services industry, and that industry blew up. And so that's why USA's bond investors, bond portfolio managers had their worst year ever in 2008 because of the high exposure to the financials. That was just that one industry or that one sector that really struggled. Maybe you're exposed to one particular macro factor like oil prices or interest rates or subprime mortgages in 2008. So there's one factor that's permeating your portfolio, and you need to sit down and test it. I used to ask hedge funds these questions like, what would happen to your portfolio if oil prices went to $200? What happened to your portfolio if oil prices went to $10? What if the 10-year treasury went to 10%? What if it goes back down? What if it goes down to 0.1%? What if inflation jumps up to 5%? What if the volatility index on stocks jumps up to 50%? In fact, in 2008, a lot of hedge funds were actually betting on the volatility index falling, and instead of falling from 30%, it instead rose from 30% up to 80% and just crushed them. So this kind of thing, you're thinking about, what is my portfolio exposed to? So when this market unwinds, I'm going to own stuff that I can't sell because it's right in the middle of the eye of the storm. You definitely have to run scenario analysis and ask people, the firms that you're investing in, what their liquidity plan is. Can they actually meet their requirements? You can hold a cash reserve. That's really expensive, especially today when cash is making you almost zero. That's a tough one. And Then this one I strongly recommend. What are your liquidity reserves? Where can you turn if you can't sell assets? And not only do you have a list of your liquidity reserves, you actually test them. So USAA, we had credit lines. We would actually go out and borrow a few $100 million, let it sit there for a few days. So we might be paying 3% and making 2%. So we're actually losing 1%. But losing 1% on a few $100 million over 3 days is not that much money. It's a few $1,000s. But we made sure that that line of credit was there when we need it. USAA, one of its biggest lines of defense was securities lending. So USAA would actually go out and test securities lending. So with securities lending, you usually lend your securities, you get collateral for that, you invest in collateral, and you make more on the collateral than what you pay to the person that gave you the cash collateral. But we would actually, instead of investing the cash collateral, we'd actually keep it and use it ourselves and test it. So there's all different ways, and there's some of our liquidity reserves where, because USA is heavily regulated by the states and the federal government, there were some of our liquidity strategies we actually had to get state approval. So we actually had to file papers with the state to say, hey, if this happened, we're going to do this with our bank. We're going to do this with our life insurance company. So if you're ever sitting in a meeting and their contingency plan is, hey, if this ever happens, we'll just borrow against our securities, you need to ask the question, are you sure you can do that? Have you tested that? When's the last time you tested it? That line of credit, are you sure it's there? If you haven't borrowed against it in 8 years, you might find when you call that bank that the person who set all that up is now retired, and the person that took the place doesn't even know you exist. It might take them 3 weeks to get going, and you need your money tomorrow. So you need to have some process that says, these are our liquidity reserves. Here's the paperwork in place. We have all the contracts. We contact these entities on a regular basis. We even do tests where we'll borrow money even though we don't need to borrow money, just to make sure it works. That is how a good firm does risk management. They don't assume things are working. And I tell you that our CEO, Bob Davis, at the time, is like, don't tell me it works, prove to me that it works. Go out and do it and come back and show me exactly how it worked. I want to make sure this company does not go under during my watch. So that's liquidity. Look at your banks. Do skim through the liquidity risk section of your bank, just so you can see if there's something more. If you find something that sounds pretty interesting that I don't have in our class notes, then definitely tell me, and I'll add it to the notes. We always struggled with liquidity risk. One thing, I'll talk on concentration. We're going to get back to concentration again, and I might say this story again. But on concentration limits, what limit do you put? Is it 1%, 2%? How much do you want in one entity? And at USA, I'll tell this again when we get the credit risk, but we didn't have those concentration limits. Bob Davis came in and he said he wanted them. And it's my job to come up with the proposal for him to approve. And I kept going back to him with lower and lower numbers, and he kept saying, no, that's not right, rerun your model. Well, I didn't have a model. And so we'll talk about this with credit risk. What is the right concentration limit? And so when you're doing your paper one and you see the word limit, one question that you can certainly ask, and I know this video, you may be watching it well after you've worked on your paper, but definitely this video will happen before the papers do. Stop and ask the question, how did they derive that limit? If they say their limit is 10% in any one industry or 5% in any one company, how did they come up with it? At USA, what we said is, I can't remember the numbers, but maybe we say we can have as much as 3% in one entity as long as they're rated single A or higher. We can have 3% if they're triple B rated, and we can't have more than 1% if they're below investor grade rated. Something along those lines. But it's tough. Liquidity risk is one of the most difficult risks to really measure and mitigate. And the ways you would mitigate it perfectly, holding a bunch of cash, is not what you want to do in a market where cash is making zero. All right, so our next topic is price risk, but I don't want to get into price risk here. So what I'm going to do is I'm going to stop here. We'll start price risk next time. So our next video, this video is only about 15 minutes. So our next video might go 70 minutes. So between the two, I'll average right at the hour that I've been trying to keep.